Guys, give a big hand for Rob Beardsley, the master at raising debt and equity, so much so he wrote the book. Big hand for Rob. Come on.
Thank you very much. I'll give it a shot here. Except not 10,000. It's got to be, I think, for this crowd, 10 million. All right, people are trickling in. Very good, very good. You don't want to miss out because what just happened? I just taught you guys how to make $10 million by next weekend. Woo! All right, thanks so much for that, and thanks for sticking around, and thanks, Tim, for having me. So my name is Rob Beardsley. I'm the founder of Lone Star Capital. We're a nearly 5-year-old multifamily investment firm based out of New York, and in the last 4 years, we've acquired over $300 million in multifamily assets, all in Texas. And today we're talking about structuring and raising debt and equity for real estate, which is actually the title of the new book that I just published, as you can see right there. The first book that I published over 2 years ago is the bestseller in the multifamily underwriting space because it is the only book in the multifamily underwriting space, which is a tragedy, but nonetheless, my first book teaches you about how to underwrite, which is the analysis process for multifamily acquisitions, but that's just step one, because when you find a good deal by the numbers, the deal doesn't do itself. Obviously, you need to be able to structure the deal, and that's where your capital stack comes in with debt and equity. So that prompted me to write my second book to kind of go into the nuances of structuring and raising debt and equity. So we're going to quickly cover debt. We don't have a ton of time, but I want to just touch on debt and then go to the good stuff, which is, of course, equity. But I want to touch on an introduction to debt. In my multifamily space, you've got fixed rate debt, floating rate debt, bridge debt, agency debt. It can get overwhelming, confusing when you're first starting out, and I don't want to go into too much detail, but I want to specifically spend time talking about agency and bridge debt. I know this is nowhere near as exciting as homes on the water, but this is the critical stuff for you to make $10 million by next weekend. So firstly, agency and bridge debt have been both hot topics in their own right over the last few years. Going back about 4 years ago, it seemed like everyone was doing agency debt, and rates were rising, so you would be nuts to do a bridge loan. Everyone said a recession was coming in 2016, 2017, 2018. Everyone was doing agency debt. Then cap rates went so low that you couldn't do agency debt, and everyone flooded into bridge loans, and nobody talked about agency. So that speaks to the ever-changing environment that we're in, and you can't just pick one strategy and stick to it because this business that we're in is always changing, and that's what I love so much about it. I love waking up every day addressing a new environment where we have to adjust our strategy. Another hot topic is fixed rates versus floating rate debt. As I'm sure you guys, just like myself, we're kicking ourselves for not fixing more loans over the last couple of years. You know, some of us chose to use floating rate debt over the last couple of years, and now rates have unexpectedly risen dramatically. And now we're wishing, wow, well, why in the world did I pick that floating rate loan? And obviously, there was reasons for it. And just because rates are increasing now doesn't mean that floating rate loans are evil. There's a lot of pros and cons, and this goes to the point of needing to match your business plan and your strategy and the deal profile to your debt product. So floating rates absolutely have a place, and they're very important when you want to have a flexible business model where you want to exit early. Maybe you want to refinance early or you want to sell in 2 to 3 years, and a fixed rate loan with a yield maintenance prepayment penalty wouldn't allow you to do so, or at least make it very expensive. And this is all just general good advice, but something that is very important in today's market that we're in right now, where interest rates have risen, and now the 10-year Treasury yields at over 3.5%. Now, everyone has their own opinions on interest rates, but the important point is going back to yield maintenance. Thing is, yield maintenance is a very expensive prepayment penalty that is adjusted based on what your interest rate is on your loan versus the prevailing rate out available in the market. So when your fixed rate is low and then rates rise, your yield maintenance prepayment penalty is virtually nothing, and it's very, very easy to get out. However, if you have a cheap loan, why would you get out of it, right? So that's not going to hurt you. Conversely, if you lock in a loan today and then rates go lower in a year, 2 years, 3 years, and you want to get out of it, that yield maintenance prepayment penalty is going to be so expensive. So right now, at least, again, everyone has their own opinions and we all have our own crystal balls, but if you are of the mind that rates may go lower in the next 2, 3, 4 years and you're going to want to re-lever your deal or refinance your deal, you want to avoid yield maintenance. And that's not free. You're going to have to pay a little bit more interest for a step-down prepayment penalty, and that's going to allow you to actually exit that loan and take advantage of potentially better rates, better lending terms in 2, 3, 4 years. Again, I don't have the crystal ball, but that's kind of our approach to the situation. Which brings me to another point about raising debt today, which is the fact that if you are looking at a permanent loan, which is sized based on in-place income, as I'm sure many of you are familiar, you are constrained by how much debt proceeds you're able to get. Gone are the days of being able to go to any agency lender and walk in and get 80% LTV. If your loan is based on in-place income, because cap rates are here, interest rates are here, the lender can only give you so much debt. Now, instead of 80, it's maybe 50, it's maybe 60. And that is dramatically changing the deal profile because, as we know, at least on paper, leverage magnifies returns. So I'll talk more about how that affects other parts of the deal. Obviously, your debt affects your equity in your structure. So when I get to the equity section, I'll touch on that. But specific to debt today, leverage is down. And that's causing projected levered returns to go down. And it's having other implications such as having a much larger equity check to raise for the same size deal. I was just joking with somebody outside that earlier this year, we were able to buy a $50 million deal with maybe $15 million of equity. Now, we're buying a $15 million deal with $8 million of equity. The math is completely changed, and that has other effects in the business, which I'm looking forward to sharing more in the equity section. So let's talk about equity. So I have some maybe straightforward but maybe controversial opinions about equity structures and how to put your deal together. And so my first thing is, and I know I'm wearing a suit and a tie, I'm old and boring, avoid creative structures. That's my advice, that's my opinion. I know other people think creatively and they have ideas on how to be different and that's going to help them raise capital. I would be wary of that. My opinion is, and I know my friend Richard Wilson, who was speaking yesterday, what he talks about is you want your deal structure to sweat for you. You don't want your deal structure to be a barrier for why someone chooses not to invest. You go through all this effort to be, as Dan Hanford says, known, liked, and trusted, but then if it comes down to it, an investor maybe likes you, wants to do a deal with you, likes your deal, but then your deal structure just isn't a fit for them, and they're going to pass. So you never want that to be the case. You want your deal structure to actually go and make the investor want to invest with you. And creative deal structures almost never work in your favor in that regard. So instead, my approach is, obviously, you don't want to be cheap. You don't want to give away the house on your deal structure, but you want it to be as market as possible. And the reason for that is there's a little bit of psychology. If you have a really cheap deal structure, maybe it's run-of-the-mill, but it's too favorable, right? You don't charge an acquisition fee, or you have a really high preferred return. That's going to cause the average investor who's comparing your deal across other opportunities skeptically. They're going to think, well, is this person not confident in themselves, or they're not confident in the deal? Why are they offering me such a good deal? It causes a little bit of concern. So creative deal structures, I think it's better to blend in with your deal structure rather than stand out. That's my controversial opinion. So what is the kind of typical run-of-the-mill blended-in deal structure? And the answer to that is, in my opinion, every deal that you're looking at, or if you are looking at structuring a deal for you and your investors, it should include a preferred return. And for those that aren't familiar, a preferred return is simply a minimum rate of return that is owed to investors before any performance compensation is able to be paid out to the sponsor. And the big misconception about preferred returns that needs to be made clear when you're talking to your investors is that and again, every deal structure is different, but the preferred return is not a guarantee. It's not guaranteed returns. also, it doesn't have an implication on cash flow. So some of my investors, when we offer in our deal structure an 8% preferred return, they automatically assume that the deal is going to be kicking out 8% cash-on-cash returns. Now, I wish. Unfortunately, in today's environment, very few deals are able to produce 8% cash-on-cash returns. So it's important to understand that when you're evaluating a deal, the deal structure doesn't necessarily speak to the projected returns. And you want to evaluate both. You want to understand, okay, what is the deal structure? Now, what are the actual projected returns from an IRR perspective, as well as a year-over-year cash-on-cash return perspective? So the next part are promote splits. So of course, sponsors, we need to make money, and your promote split should be reflective of the general market, as well as the quality of the deal and your strategy. Some strategies garner higher promote splits because there's more effort involved. For example, mobile home deals have higher promote splits because these deals are harder to find, harder to manage, and they're smaller. So you should analyze your market and figure out who's your competition, what are the deals that you want to do that other people are doing, and how are they structuring them, and figure out how to model that to your deal structure and something that you're comfortable with. So for us, it's pretty straightforward. We have an 8% preferred return with a 30% promote, and that goes up to a 15% IRR, and then there's a 50-50 split. I definitely encourage you to have a 50-50 split somewhere in your returns because it incentivizes you to outperform, and it kind of gives your investors an understanding and anchoring of where the returns may go. And say, hey, you know, after 15% IRR, we deliver that to you, there's going to be a different split where we both continue to make more money. So before we move on, the really important thing that I love talking about are the nitty-gritty nuances of preferred returns. So I always say that preferred returns aren't created equally. Some preferred returns are cash flow promote based, which I'll explain what that means. And some preferred returns are cumulative and compounding or non-compounding. And so you as either an investor or a sponsor really want to be intentional with what your preferred return is and what is it communicating to your investors. So for example, the most institutional style of preferred return is one that is compounding and is subject to return of capital. What this means is your preferred return, when it's not paid, it actually accrues and earns the unpaid portion of the preferred return, accrues interest on itself as it moves on to following pay periods. Savvy investors really love this because they feel protected by this structure. They know that if the sponsor misses a payment and is behind on the pref, they're at least going to be eventually caught up through accrued and compounded interest on that pref. The second piece of that was a return of capital. What does that mean? Well, that means that the sponsor doesn't make money not just before the preferred return is paid, but it's also after investors are received a full 100% return of their capital. So that is the most institutional structure, and if you want to make friends with all the savvy, sophisticated private equity firms and institutional investors, it is in your best interest to use that structure. If you don't use that structure, I'm not saying you should or shouldn't, but if you don't, you're communicating to your investors, if they are aware of even what the heck I'm talking about, that you are not necessarily geared up towards the most savvy, sophisticated capital sources. It's not a crime, but it's just something to consider and be intentional with how you're structuring your deals. Everything has a communication, whether you provide voting rights to your investors, it communicates something about the deal. Some people say, well, my investors don't want or need control rights, and I totally agree with you, but at the end of the day, it communicates something. So being intentional with that is really great. So I talked about different deal structures, and I talked about different investor profiles, some being more sophisticated. You've got institutional investors, family offices. So I want to talk about having a diverse equity approach. I was speaking with a gentleman yesterday, and he was asking me who are our investors? And it's hard for us to say because we don't do a good job of really niching down and having one investor. We have a very diverse group of investors. Some of our investors are small, some of our investors are very big, and they all want different things, and I think it's really something valuable to set up your business to be able to cater to these different types of investors, and I'll explain why. And actually, Richard Wilson made an awesome comment about this yesterday. He talked about the fact that if you take a sophisticated institutional approach to your business, which caters towards institutional investors, you can still take that same approach and apply it across the spectrum and still work with smaller investors. Just because you position yourself in your niche to maybe work with ultra high net worth individuals doesn't mean you can't get a $50,000 investor. However, you may miss out on some retail investors or high net worth investors. And just to give you a simple example, if on the front of your website there's a guy sitting there on the beach relaxing, and then the caption is like, passive income, let it change your life, right? Someone with 200 million net worth is going to look at that and go, ooh, doesn't resonate with them. Slimy, cheesy, they retired a long time ago, they're not in it for the beach, they're in it because they love numbers, whatever. So you have to understand who you're attracting with your marketing. And at the same time, if your website also is, hey, we're just boring numbers and we just give good returns and there's no external benefits or anything, then that doctor who's overworked and would love to get an extra $600,000, $2,000 a month is not going to resonate with that message. So you do pigeonhole yourself a little bit, but I do believe, like Richard said yesterday, if you take a more sophisticated approach across your entire business, you still can get a diverse range of investors. So why would you want a diverse range of investors? There's a lot of people in this room that probably have told themselves, hey, I have a great business, and I never need institutional investors. I'll keep on raising from my network and never think about it again. Institutional guys are a headache. They're the suits from New York, and they're just going to cause trouble. And they don't pay very high fees. So all those things are true, but I would still argue with you that it is worthwhile to have that diversity in your investor base, because you never know what type of deal you might have and who that deal might be a fit for. If you want to grow your business the most, then you're going to want to have the ability to have a certain deal that you can bring to your high net worth investors. Or maybe there's a deal that's a great fit for a private equity firm because maybe that deal has no cash flow, right, which we know that high net worth investors love their cash flow, but the private equity firm that's solely IRR driven, they don't care if the deal doesn't crank out any cash flow for the first few years. They're just seeking for that IRR to maximize the returns in their fund. So by having that diverse approach, you're just allowing yourself a better chance of getting your deal funded. Take another example. You can have different types of investors inside of one deal. If you do, for example, a joint venture with a family office and they put up 80% of the money, let's say it's a $10 million equity check, they bring $8 million, and you're responsible for the remaining $2 million. Well, it's really great if you've built up a great syndication platform for you to be able to go and syndicate that $2 million. Now you're doing a $2 million syndication in a joint venture with an $8 million check from a family office, and you're taking down a $20 million deal, unfortunately, these days. So, which brings me to my very important point, talking about what's happening today. So we talked about lower leverage and how it's causing equity checks to balloon. I mean, we're really seeing double the amount of equity that's required to do the same size deal. And that is putting pressure on sponsors' margins. Yeah, boohoo, sponsors. I know nobody feels bad for us. But what I mean by margins is if you are using partners like fund managers or co-GPs that are helping you raise capital, they don't care that your margin is squeezed. They still want to get paid what they were getting before. And that's fair. That's totally fair. So that's why the margin is squeezed. They have a certain expectation of being paid, and then there's not as much left for you because just to do a little bit of math. If you have a $20 million deal and a 2% acquisition fee, that's $400,000. Now, if you have to raise $5 million for that deal, that $5 million of equity and those partners that raise that equity get to share that $400,000 acquisition fee. However, what if you have to raise $10 million? Well, now there's double the amount of equity and potentially double the amount of partners that have to share that same fee. What are you going to do? Are you going to double the acquisition fee to 4%? So that's the squeeze that's happening on margins. And what I want to invite you to think about, there's a lot to unpack there, and that's something that's kind of new in the space that I know a lot of us are dealing with. But institutional investors, like a family office, they don't really care. They don't care if the check is $5 million or $10 million. So I'm really thinking that the next year, 2 years is going to be a fantastic time to partner with larger sources of capital because the margins are getting squeezed on the smaller stuff, so you might as well do a bigger deal with a bigger check. And it's not necessarily like you're doing a $100 million deal. You're still doing the same deals that you're doing before, but now you're just raising, unfortunately, a bunch more equity. So that was some of kind of the real-world things that we're dealing with today as far as lower leverage, squeezed margins, and the feedback that we're getting as we're talking to some of our institutional investors and partners across the spectrum on raising capital. So I raced through that really quick, actually. So greatly appreciate for you guys hanging out for this. We've got about 5 minutes left for questions, so don't go all at once.
Questions? Wow. Oh, there you go. Could you tell us a little bit about what you put in a pitch deck for your investors?
What we put in a pitch deck? Yeah, great. So there's two approaches when it comes to a pitch deck. Do you want to provide information or do you want to look impressive? And I'm saying that seriously because both can work. So if you want to look impressive, you want to have as many pages as possible, as many pictures as possible, and really be flashy and glossy. Now again, going back to diversity, that's going to attract some investors and alienate others. I've dealt with, billion-dollar private equity firm in New York. If you put in front of them a 60-page pitch deck, they're not going to look at it. They're going to be pissed. They need one page. So the big deck look impressive. The simple answer, I'll still cover the nitty-gritty, but a lot of pictures, a lot of fluff. Now, on the actual pitch deck content, you want realistically, if you can, 20 pages, more so probably about 30 pages of content that's pretty dense. And what you really need to cover are, first of all, is the team. That's what people really care about. I know the deal is super important, but the team, in my opinion, goes first. Don't put the team stuff in the back. Put it in the front. So you want to have information about your team, the company experience. You have to have your track record. If you don't have a track record slide, you're not going to be taken seriously. So as far as the pitch deck, you need to have the track record slide, the team bios, and an overview of the strategy because you're trying to paint a cohesive picture. It needs to be a picture of this is our team, this is what we do, this is our track record of doing it, and now here's another one just like this. Right? That's the story you want to paint. You don't want to say, oh, well, we dabbled into this, and now we're trying out this new thing, and we think it's going to be great. You want it to be a rinse and repeat. That's what gives investors confidence. So after that team stuff, you just need the executive summary on the deal, which includes, obviously, the basic units, square footage, unit count, type, all that stuff, projected returns, and you have to have the sources and uses. Any savvy investor is going to go crazy if you don't have a sources and uses in your pitch deck. So somewhere, preferably by the front, you need a sources and uses, and then the projected returns. And then that needs to be backed up by your business plan and your financing. That's the most important stuff. That really is the meat of your business plan, because how are you getting to the returns that you're projecting? It needs to be through a business plan and the financing. And then how did you arrive at that business plan? Okay, you're going to renovate the units and push them to $1,200. Well, how? Well, you have to prove that through rent comps, and then it's always good to justify your basis through sales comps. So that's pretty much what you need to have in your pitch deck.
One of the things I think you had in your slide was to avoid creative deal structuring. Can you talk about some of the structuring that you would and wouldn't do? So you talked about not doing creative deal structuring. Can you give some examples of what you would avoid and what types of creative deals you would say are okay to go with?
Yeah. So so first of all, what isn't a creative deal structure? I kind of covered on it, but I did rush through, so I apologize. So what is a boring deal structure is a preferred return with a promote, you have an acquisition fee, you have an asset management fee, maybe you even have a disposition fee, but at the core of it, you need to have the preferred return and then a waterfall. All right, so something that would be considered creative would be something like no acquisition fee, just we get right off the bat a 5% ownership of the deal, and that's all we get. There's creative structures like that where maybe there's no preferred return, and it's just a straight split. Those would be considered creative. And I think I talked about why I don't like those, because they stick out and not necessarily always in a good way. So that's my approach. And then as far as the actual numbers of, is it an 8% pref? Is it a 7 or a 9? That's up to you to decide based on your industry and your peers, right? Like I said, I don't know your business. I don't know which asset class or market. That's going to really more so drive the specific numbers. Anybody else? Yeah, that's a really good question. So the reality is, if you're not consciously niching, you're doing it anyway, right? So there's something that you're doing that's already niching you down and you don't even realize. And that's kind of what happened to us, actually. We niched on accident. It was just based on who we were and how we like to communicate and message. So we were never, as my business partner and I and our team and our values, we never were really excited or interested in the man on the beach. That's not what we are all about. So we naturally geared away from that, which then lost us those investors that maybe wanted that, right? Because we're not selling the lifestyle or providing, something like that. So you're already niching down. You just don't know it. And so you need to look at what you have going on, what's your messaging. This is very much so a deep dive on your marketing. But just because you're already niching doesn't mean that's where you want to be going, right? You may want to actually do something completely different. So understanding what you're already doing is the first step, but then secondly is figuring out, well, who do you actually want to actively attract? And that requires spending time thinking about your avatar. You should be able to close your eyes and picture your ideal investor in as much detail as possible, right? That is what's going to allow you to then reverse engineer into the niche that you want to be in. And, like they always say about niches, don't be afraid to niche down, because it's not necessarily going to remove your ability from being able to work with other people.
Question. Do the institutional investors and the family offices look for the pitch decks to come in, or they're actively looking for good operators to connect with?
That's a really good question. So one thing I love about working with family offices and institutional investors is that they're deal junkies just as much as I am, right? It's their job to chase the deal. So to them, it's like a shiny object. So I can hold it and say, hey, I have a new deal. Do you want to look? And that's a great way to establish a new relationship, build a relationship, and grow it. So I like using a deal as a way to get my foot in the door. However, at the end of the day, they're human just like all of us. And so they really do make human decisions, which is they work with people that they like. They work with people that they trust. So it's really no different as a retail investor, except they just have an investment committee that takes hours and hours making a decision about your deal. So it has to be a good deal. You still have to be professional, all that stuff, but there has to be that human element as well. So I would use the deal to build that relationship and then understand that that relationship is a much longer sales cycle on average. It could be 6 months, 12 months, 2 years. Our largest investor, he called me up one day and he said, hey, I've been ignoring your emails for 3 years. Let's talk. So, but to your point about the pitch deck, we have never had a large investor invest because of the pitch deck. Or we didn't even have the pitch deck when they agreed to invest, because they don't need it, and we got them involved before the pitch deck. That's the other thing. You want to get them involved early, because they prefer to have time on their side. They would much rather see the deal as early as possible, with the caveat that they want to look at deals that are under control. They don't want to be pitched deals that you don't have control of, and now they're chasing, and then it's not an actionable deal in the end. So you have to be aware of that. But we actually put together a one-page memo when it comes to talking to our larger investors, because we can put together a one-page memo in a day, and it's all the information that they need to make a decision.
All right, Rob. Everybody give Rob a big hand. Thank you very, very much, Rob.